To our next guest, who is skeptical of this equity rally, says to brace for a hard landing and to bet on bonds, going underweight on equities. Joining us, Northwestern Mutual Wealth Management Chief Investment Officer Brent Schutte. He oversees $255 billion in assets under management. Brent, it's great to have you here. So what's your take on the messages we got out of these Fed speakers today, where it sets us up going into next year?
Yeah, I lean towards more towards Bowman. I do believe inflation is still a real thing. To me, the most important thing is what happens in the labor market. And this is where I think to get inflation sustainably, keyword, back to 2%, you need wages to come down from the 4.5% or so they're at right now, back to around 3 to 3.5%. Unfortunately, historically, the only way that has occurred is through job losses and a recession. And to me, once those start occurring, once you start seeing job losses, typically they continue to compound until you get around 2% rise in the unemployment rate, which we're kind of getting on the precipice of getting past that point of no return where the unemployment rate is up 0.5%. Past that, there's nothing between that and 2%, at least historically. And so to me, that's where I think the rubber meets the road. I think, unfortunately, wages, the only way they come down is through job losses, which we'll call that a recession.
You know, yeah, today's Conference Board Consumer Confidence labor market measure did show a little bit of an uptick in folks saying jobs are hard to get. So you're seeing signs that the labor market has been loosening up. But you have this other take out there that we have structural tightness, all the demographic reasons. You've had companies that were in labor scarcity and couldn't find people just a couple of years ago. Maybe they're going to be slower to lay people off. So you know that story. And that, I think, probably underpins part of the soft landing thesis. But you don't think that's going to hold out?
No, I don't. You are seeing the labor market weaken. In the last jobs report, you actually saw the number of industries actually hiring, I believe, down to 52%, which historically has been that narrowing right before a recession. Continuing claims are up, I believe, 24% year over year. I don't believe we've ever seen a rise in continuing claims that high and not had job losses follow or a recession follow. And so you are seeing a variety of labor market indicators cooling off. I guess the question to me, and you mentioned the word, I think, threading the needle. Can the Fed exactly land this plane on top of a needle and have job gains slow down, but not have the economy go too far and where you actually have job losses? And to me, with the lags in monetary policy, with all the tightening that we've done, I still think it's more likely than not they can't land it exactly. And you will have a period of time where you do see job losses, and that will put a wet blanket on the market.
So my question is, the market impact and what you do if you're feeling a little more bearish, Brent, as you are, because a lot of S&P 500 stocks, despite the overall index, are still way off more than 20% from their highs.
Yeah, I mean, so first and foremost, I want to make sure that people understand that investing in bonds actually has real return possibilities now. I think the average retail crowd doesn't believe that because they've had actual losses for the past few years, and they don't want to invest in bonds anymore. And I would encourage people to look in other things other than cash. And so actually locking in some of those longer term yields. But you're right. The market, I think a lot of parts of the market have actually discounted some sort of recession already. You have small and mid cap stocks that I believe are off 20% from their highs. The average stock in the S&P 500 or the equal weighted stock index, I think trades at 15 times earnings. And so I don't think it's a dire story for equities. I just think in the near term, as the macro conditions continue to weaken, that you want to make sure that you have an allocation to fixed income and that it's not just cash, but actually bonds out further on the yield curve that will do better as those finer embers of inflation burn out with a recession.